Hey everyone, welcome back. I am absolutely thrilled about today's explainer. We're going to be breaking down the exact mechanics of a 10-year, perfectly boring strategy that, believe it or not, creates incredible wealth. Now, we aren't looking at massive leaps today. We're not talking about risky gambles or trying to predict the next giant tech boom. None of that. Instead, we're looking at a super simple, highly structured blueprint that transforms a tiny monthly habit into a massive financial safety net. So if you're ready to see the real secret of compound interest in action, you are absolutely in the right place.
Okay, let's dive right into this. We are so conditioned by social media and sensational news to believe that building wealth requires, a massive salary or a once-in-a-lifetime business idea, or honestly, just sheer dumb luck. But I really want you to ask yourself, how much wealth could you realistically build if you took a completely unglamorous, totally boring $300 a month and just put it to work? It's so easy to look at $300 and think, well, that's not going to make a dent. But as we're going to see today, true wealth is rarely about the big leaps.
Section 1. The Wealth-Building Illusion.
To really understand why this strategy works, we first have to break through what I call the wealth-building illusion. Look, almost everyone tries to invest at some point in their lives, right? People buy a stock, they jump on a crypto trend, they open an account, but the defining difference between the wealthy and everyone else isn't who starts investing, it's who sustains it. True wealth is built on small, unbroken decisions over a really long period. And hey, it's not actually your fault if you struggle with this. Neuroscience reveals a fundamental truth of behavioral finance. Our brains just prefer short-term comfort over long-term wealth building. We are literally wired biologically to survive today, not to plan for a decade from now. Spending money today hits you with that immediate dopamine. It feels great. Saving for tomorrow? That feels abstract, almost useless. When you hold $300 in your hand, your brain tells you that putting it away won't change your life, so you might as well go spend it. The tricky part is people rarely realize they've made the wrong choice in the moment. They usually only realize it 10 years too late.
Section 2. The $300 a month strategy.
That brings us to our core case study for today's explainer. Let's play What If. What if, exactly 10 years ago, back in 2015, you decided to just ignore all the noise? What if, without trying to get rich quick, you committed to investing exactly $300 every single month into a dividend-focused fund, and you never, ever stopped? We aren't talking about risky growth stocks here. We're talking about a super conservative, dividend-heavy approach. If we jump onto a screening tool like ETFdatabase.com, for example, we want to find a highly secure, high-volume fund. First up, we filter for equities, specifically large and mega-cap companies because, well, these are from massive, deeply established businesses. Next, we select a dividend strategy. For our yield, we want it to be above 3%. Since we aren't chasing aggressive growth, a strong, steady yield of over 3% is going to be our engine. And finally, we absolutely need an expense ratio of less than 1%. When you apply these exact filters, one of the heaviest hitters that pops up is the Schwab US Dividend Equity ETF, ticker symbol SCHD. It has massive trading volume, which drastically lowers the risk of manipulation and ensures you can always buy and sell with those scary price gaps.
And check out this incredibly tiny expense ratio, 0.06%. Why is this so absolutely crucial? Because when you hold a fund for 10 to 20 years, high management fees can silently eat up to 20% of your total principal. Keeping costs this low isn't just a nice-to-have, it's an absolute necessity for a long-term buy-and-hold strategy.
Now, what's really interesting about these numbers is that the sheer math of consistency is staggering. If you put in $300 a month from 2015 to 2025, your total out-of-pocket contribution is $36,000. But your final account value, it sits at nearly $70,000. You essentially created over $30,000 literally out of thin air with zero deep financial knowledge, zero market timing, and zero stress. And here's the harsh reality. If you hadn't automated that $300 a month, you wouldn't just have that $36,000 sitting safely in a bank account. Let's be real. You likely would have spent it on dinners, weekend trips, and fleeting conveniences, leaving you with absolutely nothing to show for that entire decade.
Section 3. The Power of Drip.
So how exactly did $36,000 turn into $70,000 without taking on any aggressive risk? Well, it requires a secret weapon, and that secret weapon is called DRIP, which stands for Dividend Reinvestment Plan. Here is how it works in plain English. Instead of taking the cash dividends that the fund pays you and spending them, you have your broker automatically use that cash to buy more shares of the exact same fund. It's essentially buying more of the asset for free. And here is the absolute genius part of it. When the market drops and the ETF price goes down, your automated dividend buys even more shares at a discount. This creates this relentless, exponential compounding loop that just builds your wealth on autopilot. And you can clearly see that compounding loop in action right here. Remember, your monthly input stayed exactly the same, just $300 a month. But your passive income? That tells a very different story. In 2016, your first full year, you received a pretty modest $75 in dividends. By 2020, that jumped up to $806. And by 2024, it skyrocketed to $2,134 in just one single year. You are still only putting in $300 out of pocket, but the machine you built is now handing you over $2,000 a year in passive income, and that number is only accelerating.
And it's not just the number of shares that's growing. The efficiency of the shares themselves is increasing. Back in 2011, this specific fund paid out just 12 cents per share. Today, it pays out $1.05 per share. So you actually have a double compounding effect happening simultaneously. You're accumulating more shares for free through DRIP, and the cash output of every single individual share is multiplying. It is literally a dual-engine wealth builder.
Section 4. Dividend ETF versus S&P 500.
Now, I know exactly what a lot of you are probably thinking right now. If the stock market is so great, why not just put that $300 a month into a massive growth index like the S&P 500? It's a super common question and honestly, a completely valid one. Over that exact same 10-year period, an S&P 500 ETF like SPY would have turned your $36,000 into roughly $90,000, outperforming the dividend ETF's $70,000. So why choose the dividend route? Well, look at the difference during a crisis. During the really severe market crash of 2022, the S&P 500 plummeted by 18%, but the dividend ETF, which is heavily weighted in protective, cash-flowing sectors, dropped only 3.23%. So while SPY definitely makes more money overall during bull markets, a dividend strategy provides massive psychological and emotional protection during crashes. It acts like an anchor that prevents people from panicking and selling everything.
What this really comes down to is understanding what kind of investor you actually are. There are three competing goals here. First, regular cash flow, which provides immense psychological comfort. Second, growth combined with dividends, which yields the highest long-term results but requires extreme patience during those painful down years. And third, low volatility, which protects your mental health from massive market drops. Almost 90% of investors make the fatal mistake of expecting all three of these things from a single ETF, but you just cannot have maximum growth and maximum protection simultaneously. You have to choose the strategy that fits your own behavioral tolerance, or build a balanced portfolio that incorporates different funds for different jobs.
Section 5. The psychology of quitting.
Ims brilliantly illustrates a really tough question. If becoming wealthy is as simple as clicking a button to automate $300 a month into a secure fund for 10 years, why isn't everyone walking around with massive portfolios? The answer shows us the harsh reality of human nature. Imagine 100 investors starting this exact $300 a month strategy on the exact same day. By the end of year 1, 15 people have already quit. By year 5, 45 people are gone. By the time we hit the 10-year mark, 60% of the original investors have completely abandoned the strategy. Only 40 out of 100 people actually cross the finish line to see that $70,000. The math works perfectly every time, but the humans executing it, they fail.
Let's break down exactly why that 60% crashes out. It's almost never because they simply ran out of money. The data shows that 45% panic sell the moment the market gets rocky. Another 30% get bored because there's no instant gratification. Remember, year 1 only pays out $75 in dividends, which feels like a total failure to an impatient brain. 35% try to get clever and time the market, buying and selling to maximize gains, which, let's be honest, almost always backfires. And a staggering 50% simply fail to automate the transfers. They rely on willpower every single month instead of just using technology. Boredom, impatience, and manual mistakes destroy wealth far, far faster than bad stock picks ever will.
There's this phenomenal concept from financial writer Morgan Housel that explains this perfectly. He says people don't miscalculate the future, they minimize it. When you hold $300 today, your brain thinks 10 years is an absolute eternity away. You minimize the reality that the 10-year mark will inevitably arrive, and you prioritize today's desires. That is exactly why a $300 investment today feels incredibly unimportant, even though it is literally the exact building block of your future security.
Section 6. The reward of patience. We really have a clear narrative arc here. On one side, we have the market timer. The person waiting for the perfect moment, the big salary bump, or that ultimate stock tip to finally get started. On the other side, we have the perfectly boring investor, ruthlessly deploying $300 every single month without an ounce of emotion.
I want you to remember this really simple truth about the mechanics of compound interest. The first 5 to 7 years are incredibly boring. The math feels slow, the dividends feel tiny, but if you can survive that boredom, the rest of the timeline is completely transformational. The boring investor who uses time as their ultimate asset will mathematically obliterate the person sitting on the sidelines waiting for the perfect time to make a big move.
I'll leave you with this really powerful data point from JP Morgan. 60% of long-term returns happen in the last 25% of the investment timeline. Just when the impatient masses quit, the true wealth begins to explode. Most people give up right before the math goes vertical. So the million-dollar question for you isn't whether you have enough money. The question is, do you have the discipline to endure the boring years so you can finally reach that explosive 60% at the finish line? Let me know your thoughts down in the comments, and I'll catch you in the next explainer.